Welcome to Property Gyan. I am Sahil Verma, COO at Shray Projects, and today we are going to be tackling something that affects every NRI investing in Indian real estate: taxation. In recent years, we have seen a significant surge in NRI investments in Indian real estate, whether it be for generating rental income, securing a future home, making new strategic investments, or even exiting from existing ones. Understanding the landscape of taxation is crucial. Most of the NRIs find themselves to be lost in a maze full of regulations, tax implications, and compliance requirements. Today we'll demystify these complexities, provide you with actionable insights that can help you save money, prevent costly mistakes, and help you make an informed investment decision. Our goal today is to transform tax challenges into strategic opportunities. All the discussion today that we will have is going to be according to the taxation laws by the Government of India. Let me start with the simple truth. Understanding taxes can save you lakhs of rupees and countless headaches, whether you've already invested or are planning or even seeking an exit. This guide will help you navigate the Indian tax system confidently. Now think of this as your roadmap to smarter real estate investments in India. We'll cover everything from basic tax rules to money saving strategies that most NRIs miss out. Let's begin by understanding what an NRI is for taxation in India. According to Indian tax laws, your residential status is determined by your physical presence in India and your income source. You are considered as an NRI if you have stayed in India for less than 182 days in the financial year, have been out of India for business or employment purposes, or have your primary economic ties outside of India. Your residential status directly impacts how your real estate income is taxed. It determines whether you will be taxed on your global income or only India sourced income. This distinction is critical for tax planning and deeply affects your net return. Key factors include duration of stay, purpose of stay, which could be employment, business, or personal, location or primary economic interest, and income sources across geography. As an NRI real estate owner, your real estate income primarily comes from two sources: rental income or capital gains from property sales. Rental income taxation. Talking about rental income taxation in India, rental income is taxable in India wherever you may reside. Tax is calculated at standard income tax rate. You can claim tax deductions via municipal deductions and 30% standard deduction. TDS, tax deducted at source, is usually 30% if no PAN card is provided. Rental income is taxed on a presumptive basis if certain conditions are met. Now, talking about capital gain taxation. Capital gains tax is usually taxed after exit from an investment. If you've sold a property within 2 years of purchase, you will be taxed with short-term capital gains at your applicable income tax rate. If you've held on to the property for more than 2 years of purchase and then sold it, in that case, you will be charged with long-term capital gains. And NRIs are taxed at a flat 12.5% rate with having no indexation benefits. There are certain TDS provisions also. TDS means tax deducted at source. When an Indian is buying a property from an NRI, the buyer must deduct 20% TDS of the transaction and deposit it with the government. This TDS is applicable for all transactions that are 50 lakh and above. Sellers must obtain a TRC, which means a tax residency certificate, to claim beneficial tax with any treaties that India might have. Now let's deep dive into gains and exemptions. Capital gains tax and exemptions is where most NRIs can optimize their strategy for real estate investing. Let's break it down into further fragments. Section 54 exemption is your tax saving weapon. It allows complete exemption from capital gains tax. But there are some conditions. Reinvestment of all the proceeds into any other residential property in India. Investment must be done in 1 year of property sale or handover in 2 years if investing in an under construction property. This exemption can only be used for one residential property and the maximum exemption limit is rupees 2 crores. There are certain additional exemption strategies that an NRI can have. There is an exemption of rupees 50 lakhs if the invested amount for sale can be invested in specified bonds under section 54 EC. Reinvestment of residential property can be in your name or your spouse's name, and it is a time-bound process with strict documentation for taxation. Repatriation and currency consideration. Repatriation isn't just about moving money. It is about understanding complex financial regulations. According to RBI guidelines, NRIs can repatriate about $1 million in a financial year. Property sale proceeds have specific repatriation limits and must route transactions through NRO or NRE account and requires proper documentation and bank approvals. Just an insight into currency conversion. Use authorized bank dealers for transacting. Aware of current exchange rates. Consider timing of transactions to optimize conversion rates. Understand international bank charges and conversion costs. Now let me give you a proactive approach to taxation. Successful NRI investing is about strategic planning and not just compliance. Few key strategies that I would like to highlight are: maintain detailed financial records and stay updated on changing tax laws. Consider professional tax consultation and investments with long-term tax efficiency. Understand bilateral tax treaties between two countries. Use technology and digital platforms for easier compliance. Get an experienced and a trusted real estate broker involved, especially who has dealt with NRIs before. Common pitfalls that I would advise you and I would like you to avoid: ignoring TDS requirements, delayed tax filing, maintaining of proper documentation, and lack of understanding of tax treaty regulations. Now to conclude with my final thoughts, I believe real estate taxation for NRIs is complex, but it is not insurmountable. With the right knowledge, strategy, and professional guidance, you can turn these challenges into opportunities. Remember, knowledge is your best investment. Always seek professional advice, whether it is for tax or real estate investment. Informed about changing regulations and view taxation as a strategic tool and not just a compliance requirement. Thank you for joining us on our channel. If you found this video valuable, please like, share and subscribe. Also drop your comments in the comment section below and I will make sure to address them in the future videos. And remember, smart tax planning isn't about paying less. It's about paying right.